Welcome to this week's Market Wrap-Up. I'm your host, Prem. In the last 1 week or so, global stock markets witnessed extraordinary volatility that exposed deeper structural vulnerabilities beneath the surface calm. While Indian markets scaled new highs, the US confronted banking sector fears and a brewing US-China trade war threatened to unravel months of stability. Today we'll go beyond the headlines to understand the cause and effect chains that moved billions of dollars across global markets, with special focus on India. The US-China rare earth crisis. Let's start with the catalyst that sent shockwaves globally. On October 9th, China dramatically expanded its rare earth export controls, not just adding 5 new elements, but implementing extraterritorial jurisdiction with a 0.1% de minimis rule. This wasn't merely protectionism, it was economic warfare. China controls 90% of global rare earth processing, materials critical for semiconductors, electric vehicles, and defense equipment. By requiring foreign companies to obtain Chinese government approval, even for products containing trace amounts of Chinese rare earths, Beijing effectively gained veto power over entire global technology supply chains. President Trump retaliated on October 10th with threats of 100% tariffs on Chinese goods, effective November 1st treat. This triggered a cascade. US stocks experienced their worst day since April, with the S&P 500 plunging 2.71% and Nasdaq falling 3.56% on October 10th. Gold surged past $4.300 per ounce as investors fled to safety. Bitcoin, often touted as digital gold, collapsed from $121,000 to $104,000, a stunning rejection of its safe haven narrative. Both nations simultaneously imposed reciprocal port fees on each other's vessels starting October 14th. China's 400 yuan per net ton fee, and America's matching structure, physically disrupting $3.2 billion worth of annual shipping operations. Companies like Costco scrambled to reroute vessels while South Korean shipbuilder Hanwha Ocean faced Chinese sanctions, its stock dropping 6%. US banking sector tremors. While trade tensions grabbed headlines, a more insidious threat emerged in America's regional banking sector. On October 16th, Zions Bancorporation disclosed a $50 million charge-off related to fraudulent commercial loans, while Western Alliance filed fraud allegations against a borrower. Their stocks plummeted 12% and 10% respectively. This wasn't random. 3 interconnected failures occurred. First, the September bankruptcies of Tricolor, subprime auto lender, and First Brands, auto parts supplier, exposed overleveraged lending. Second, multiple banks had extended credit based on the same collateral, classic asset double pledging fraud. Third, rising interest rates since 2024 have stressed borrowers who took cheap loans during the pandemic era. JPMorgan CEO Jamie Dimon warned investors on October 15th, "When you see one cockroach, there are probably more." This metaphor captured market psychology perfectly. Banks tapped the Federal Reserve's overnight repo facility for $15 billion, an emergency measure unseen since COVID-19, signaling liquidity stress. European and Asian bank stocks sold off Friday, October 17th, as investors questioned whether fraud and credit stress were US-specific or systemic. The KBW Bank Index fell 7% for the month, while the IMF's October 14th Global Financial Stability Report warned of stretched asset valuations and disorderly market corrections ahead. Prescient timing that spooked markets further. India's divergent strength. Now, India's remarkable story. While global markets trembled, Indian indices soared. The Nifty 50 closed at 25,709 on October 17th, marking its highest level in a year. The Sensex jumped 484 points, and most remarkably, Bank Nifty hit an all-time high of 57,651, up 10,000 points from March lows. Let's look into the fundamental drivers. First, the FII reversal. After pulling out 1.98 lakh rupees crore in 2025, foreign institutional investors suddenly turned net buyers in early October, pumping in over 10,000 crore rupees across primary and secondary markets. Why? 3 factors. Anticipated US-India trade deal amid US-China tensions, expectations of Fed rate cuts improving emerging market flows, and relatively modest Indian valuations compared to overstretched US markets. Second, the RBI's aggressive intervention. On October 15th, the Reserve Bank of India conducted its largest dollar sales in 4 months, engineering a 0.8% rupee appreciation to 88.07, deliberately squeezing speculative short positions. This wasn't just currency management, it was sending a signal of economic strength and stability that attracted foreign capital. Third, sectoral rotation. Banking stocks rallied ahead of Q2 results from HDFC Bank and ICICI Bank on October 18, with investors expecting stable asset quality and margin expansion. Public sector banks like Canara Bank surged 52% from March lows as government infrastructure spending accelerated. The consumption story Asian Paints rallied nearly 5% on October 17, not just on falling crude oil prices reducing input costs, but because its October 12 commissioning of a UAE white cement facility signaled international expansion confidence. This reflected broader optimism about India's festive season consumption, with Dhanteras on October 18 and Diwali on October 21 driving jewelry, electronics, and discretionary spending. The contrarian play. While IT stocks like Infosys and Wipro fell 1.75% and 4.71% respectively, despite decent Q2 earnings, pressured by concerns over US H-1B visa fee hikes and potential outsourcing taxes, this weakness was offset by strength in FMCG, auto, and banking sectors, demonstrating India's increasingly diversified economic base. Now let's look into the macro crosscurrents. Three structural forces converged this week. First, the US government shutdown paradox. The US federal shutdown, entering its third week by October 19, created a policy vacuum. The Treasury Secretary estimated $15 billion weekly economic losses, yet markets initially shrugged this off. Why? Because the shutdown delayed crucial economic data releases that might have forced the Federal Reserve to hold rates higher. The October 29 Fed meeting is expected to deliver a 25 basis point cut with 97% probability, but without jobs data, this becomes a blind cut based on incomplete information. Second, the valuation disconnect. The S&P 500's Shiller PE ratio hit 40, levels seen only before the 1929 crash, 2000 dot-com bubble, and 2007 financial crisis. Yet markets kept climbing on AI optimism. TSMC's October 16 earnings beat, with 39% profit growth and raised full-year guidance validated AI infrastructure demand. Oracle projected its cloud revenue will hit $166 billion by 2030, a 75% annual growth rate. These earnings justified tech valuations temporarily, but the IMF warned such stretch prices increase disorderly correction risks. Third, the gold-Bitcoin divergence. Gold hit record highs at $4.227 per ounce, while Bitcoin crashed 8% in October. This destroyed the digital gold narrative. The cause? Institutional investors treating Bitcoin as a risk asset correlated with tech stocks, not as an inflation hedge. Gold benefited from central bank buying, geopolitical uncertainty, and physical demand during India's festive season, while Bitcoin lacked these fundamental supports. So what's the week ahead, and key takeaways? This is what investors must watch. First, the Trump-Xi meeting scheduled for late October in South Korea will determine if the 100% tariff threat materializes November 1, or if negotiations diffuse tensions. Trump signaled on October 17 that the tariff isn't sustainable, potentially an opening for compromise. Second, Indian markets face a crucial test with HDFC Bank and ICICI Bank earnings on October 18 and Reliance Industries results, showing 14% profit growth. These will validate or challenge the recent rally. Third, the Fed's October 29 decision lacks critical data due to the shutdown, meaning policy is flying blind, increasing miscalculation risks. The core insight this week exposed that apparent market calm masked deep structural tensions, US-China decoupling, accelerating through rare earths, regional bank stress revealing credit quality deterioration, and valuation extremes making markets vulnerable to sharp corrections. India's outperformance wasn't luck. It reflected fundamental strengths: manageable inflation at sub 2%, strong domestic consumption, RBI's credible interventions, and positioning as an alternative to China in global supply chains. The key lesson: in interconnected markets, local strength can't fully insulate from global shocks, but structural advantages, India's young demographics, digital infrastructure, and policy stability, provide meaningful buffers. As we approach Diwali's Muhurat trading on October 21, investors should balance festive optimism with awareness that global storm clouds are gathering. That's your deep dive into the week that was. Remember, in markets, understanding the why behind price moves is more valuable than just knowing the what. Until next time, stay informed, stay analytical. See you tomorrow morning.